All right, good morning, folks. Welcome back to the Peterson Institute for International Economics. It is my pleasure, honor, and actually a very exciting privilege to convene today's conference on labor market slack, assessing and addressing it in real time. We have a great group, truly, of speakers and panelists and chairs, and also of select people in this audience, but we're of course going out live via the web to the world at large, and we welcome everyone who can tune in for today's presentations and discussion. Clearly, the question of what is labor market slack and how we can deal with it in practice, and what we should be doing is one of the critical issues facing economic policymakers today. I mean, obviously a great reason for this event and for this discussion is how acutely this is an issue for the Federal Reserve at the moment, as Chair Yellen and others have pointed out. But it is an issue that is going to be with us for some time across a variety of central banks, because it is reflecting some underlying issues that are at the nexus of labor markets and macroeconomics that have emerged in recent years. We live in a world where wage inflation and inflation more generally have become relatively disengaged from each other, and this dates back to be prior to the crisis in the advanced economies. We live in a world, perhaps not coincidentally, where the wage share of the economy, the labor share of the economy, has been flat or trending down in a wide variety of economies. And we live in a world where traditional measures of unemployment do not seem to fully capture the reality of the labor market and its distress, including in places such as Spain and Greece for one reason, the United Kingdom for another, the US for a third. It may not be all one answer, but there is a general problem. And for this reason, I am, as I said, delighted to have with us today an outstanding group of economists, many of whom are friends and colleagues of long standing, all of whom are making a combination of research and policy-based contributions to the public debate, and we look forward to having this be an active discussion and debate today. In particular, I'd like to thank those senior officials who've taken time to join us today. Most importantly of all, of course, Charles Evans, President of the Federal Reserve Bank of Chicago, who will be giving the luncheon keynote and who's shown such leadership on these issues both publicly and within the FOMC over the last few years. But also Erica Groshin, Commissioner of the Bureau of Labor Statistics, Wendy Adelberg, Associate Director of the Congressional Budget Office, William Washer, Deputy Director of Research and Statistics at the Federal Reserve Board. Later today, Karen Dinan, Assistant Secretary for Economic Policy at the U.S. Treasury. And of course, leading us off, Professor Betsy Stevenson of the U.S. Council of Economic Advisors. This is an extraordinarily solid lineup, and we have a bunch of no less distinguished, although less important, academics and scholars and policy people, including myself, who will kibitz in as well. Just two more words, one housekeeping and then one substantive. In housekeeping terms, we are asking the chairs, who are very distinguished, to not spend time introducing people with bios. There is a full bio available attached to the agenda for those who want it, and those who haven't collected the famous Economist baseball card collection for these people. All that will, of course, be on our website. Similarly, each session we're going to try to have direct engagement among the participants on the panel, but we are, of course, going to open it up to the audience as well at the end of each session. There will be a traveling mic up front. There'll be a standing mic at back. Anyone in the room is free to ask a question. It's all on the record. We just ask that A, you identify yourself when you ask a question, and B, you try to pretend it's a question, not a speech. Finally, on substance, just to try to give you the logic of our very full program, we want to spend the first half of the day looking at the issue of assessment. So the first panel is focused on the current situation in the U.S., looking at some of the long-term demographic trends, the shorter-term price pressures and wage pressures or absence thereof, and the factors that go into that. How do we disentangle those? Our second session is about, more broadly and generally, how do we construct estimates of slack. We're delighted to have participation not only of Wendy from the CBO, but Michael Horrigan from the BLS, Bill Washer from the Federal Reserve Board, and Andrew Levin of the IMF and now Dartmouth, who are going to talk to us and get into some of the nitty-gritty of what are the estimates and what are the judgments you have to make those estimates. As I mentioned, President Evans will speak over lunch, and then, assuming that President Evans has not solved every problem in the world, we will move on to policy discussions in the afternoon. Our third panel will be about shorter-term cyclical and monetary policy. What is still left to be done? Is there room for monetary policy or not to do more right now and in general when faced with this kind of labor slack? And then finally, and perhaps our most internationally minded panel, we will be talking about structural reform in labor markets. What kind of structural reform does the U.S. need, if any, or if a lot? What lessons we can take from elsewhere, and how to put that into practice. So again, I am extremely grateful to all of you for joining us, particularly my colleagues on the program, and let's get right into substance. If I can ask Erica Groshin and the members of the first panel to come up. Thank you very much.
I'm on the extreme left. Yep.
Okay, I see the mics are on already. That's a good sign. All right, well, let me jump right in. We're going to go in the order in which we are seated, which makes that easy. And my first panelist is Betsy Stevenson of the Council of Economic Advisors. Betsy.
Great, thank you. It is a pleasure to be here to talk today about the labor market and the outlook for labor force participation. And as I'm starting to speak, I'm realizing I have no idea how to advance my slides. Maybe that will just happen magically. Oh, I could get up.
Or you can use this thing and hope that works.
Yeah.
Technology has not replaced the IIE yet.
I'll stand up. So that, Okay. Well, the slides will come up because there's not much there, just a few graphs to sort of show what I'm saying. And the first thing I wanted to lead off with is simply the fact that the economy has been noticeably recovering on many economic indicators. Perhaps no recent economic development's been more surprising than the rapid decline in the unemployment rate, which, if the slides were up there, you would see has been declining. But I'm sure you already know that, so I wouldn't stress too much about seeing a picture of it. But what I think is worth noting is that it's coming down across all the different measures of unemployment, whether you use U3, U4, U5, do we include the discouraged workers? Just to put this in perspective, for most of the last 7 years, the blue chip consensus forecast expected the unemployment rate to be around 7% right now, but instead the unemployment rate is just over 6%, which is approximately 3 years ahead of these forecasts. The general pattern holds across genders, age groups, race, and ethnic groups. And CEA has taken a look across many different dimensions, and what we see is that the unemployment is about 70 to 80% of the way recovered. So it's continuing to increase at a rapid rate, but of course there's still more to be done. It's not fully recovered. But and there remain open questions about how many people not counted among the unemployed can be pulled easily back into the labor force. And that's the nature of most of the discussion you're going to have today. Just how much slack is there beyond what we see with U3. What I'm going to focus on today is the participation rate, but what I want to highlight for you are 5 challenges that the Council of Economic Advisors sees in the labor market, most of which predate the recession, but are becoming more relevant as we're starting to recover. And these 5 related challenges are elevated rates of long-term unemployment. As all of you are aware, long-term unemployment rose very quickly in this particular recession and continues to be a challenge. I'm going to talk more about it and its relationship with the participation rate. What I think people are a little bit less aware of is the fact that the share of the unemployed who are long-term unemployed has actually been rising pretty steadily over time for many decades. It just spiked up in the recession, but this is likely to continue to be a challenge in the U.S. economy. The number of people working involuntarily part-time is a challenge. The decline in labor market fluidity and the increased inequality in wages and income. So let me turn to thinking about the labor force participation rate. And the labor force participation rate rose in the 1970s and 1980s, largely because of the increase in women in the labor force. And it started to fall in the 2000s and fell extremely sharply in this recession. It has not recovered the way unemployment has, and that's led many people to wonder whether or not this recovery has been marked by large numbers of people dropping out of the labor force. So what the Council of Economic Advisors did was took a deep look at what explains the decline in the participation rate. And if you start with the fourth quarter of 2007 and look to the second quarter of 2014, what you'll see is participation has fallen by 3.1 percentage points. And again, I've got a nice long run graph showing you that, but I suspect many of you already know it. What we did was decompose the decline in labor force participation into 3 factors. The aging population, which is responsible for 1.7 percentage points of the 3.1 percentage point decline, slightly more than half of the total decline. So this is where it's worth to pause for a moment and say that most forecasters expected labor force participation to decline starting around 2008, because 2008 was not only the year of the Great Recession, but it was, in fact, the first year that the baby boomers turned 62 and began becoming eligible for early retirement. So although older workers today are participating in the labor force at higher rates than older workers of previous generations, it should be clear, although I find, unfortunately not always, that even when older workers participate at higher rates than previous generations of older workers, they are not magically turned into young workers participating at extremely high rates. So that increased participation of people over 55 is really a drop in the bucket compared to the impact of their cohort entering the retirement years. I think what's important there is that is a part of participation we do not expect to rebound. In fact, we expect it to continue. Typical business cycle effects are currently responsible for an estimated 0.4 percentage points of that 3.1 percentage point decline. So elevation in the unemployment rate typically coincides with a decline in labor force participation as potential workers defer looking for a job until the economy improves. That, again, should be sort of obvious. What we did was a lot of analysis to quantify just how big that effect is. And what we estimate is that as the unemployment rate continues to recover, that will pull about another 600,000 people back from non-participation into participating into the labor force. Now, you'll notice that adds up to 2.1 percentage points, and what we have is a 3.1 percentage point decline. So I've got a percentage point that we just are missing, and it's not easily explained by either standard cyclical effects or by the aging of the labor force. So we have three thoughts on what might explain that additional 1 percentage point. One thing is that it is largely explained for by unemployment duration. Now, you might think that's the end of the story, but in graduate school, we're taught that if you test one hypothesis and can't reject it, doesn't mean that there aren't other hypotheses that you won't be able to reject too. So I want to emphasize the humility with which we say this, but I do think it's worth asking whether or not the standard relationship we see between unemployment and participation may actually differ based on whether the unemployed are disproportionately long-term unemployed. In other words, do the fact that the unemployed have been looking for a very long time discourage even more people from participating? Our estimates suggest that indeed may be the case. Another issue that I hope you talk more about today is declining fluidity in the labor market. The quits rate has declined enormously in the recession and has not recovered fully during the recovery. And with there being fewer job openings, you might think that people are less likely to be pulled back into the labor market. Many people find their jobs serendipitously. With fewer openings, there's fewer of those serendipitous moments. A final issue that we think about is whether or not the pre-recession declines sort of got pushed into our residual, and therefore some of this may be due to sort of the pre-existing trends. For instance, male labor force participation has been declining for about 60 years. We don't really know why it's declining, but a sensible forecast in the face of a downward trend for 60 years is to consider that it may continue. So I think that now the one graph that I'm sad that you will miss is that we do, in fact, show what our forecast is for the participation rate. And what we find is that as the economy continues to recover, of course, the cyclical component will disappear. We model what, sort of depends on what you think happens with that 1 percentage point. But no matter what, without meaningful policy changes, it's unlikely that we're going to see participation really increase. We expect it to be flat and then continue to decrease as the baby boomers go deeper into those retirement years where participation is even lower. Our population will shift to having a larger share that are in their 70s and 80s. And if you think people in their 60s don't work very often, people in their 70s and 80s work even less often. Now, of course, participation is not a goal unto itself. If more people retire because they are older and saved and contributed their full working lives, that can be beneficial. Likewise, if young people are delaying entering the labor force because they're studying, this development increases our skilled workforce and benefits our future economic performance. But the declining participation rate does reduce our potential economic growth and exacerbates our future fiscal challenges. Moreover, not all of the decline in participation we have seen is the result of natural and good developments. In fact, the long-term trend of declining participation and employment rates for many groups, such as prime-age men, and particularly young black men, is troubling and merits a policy response. So, in conclusion, I'm going to mention just a couple areas where the administration's thinking about policy responses to participation. So, to help offset the decrease in participation and facilitate greater participation, the administration's moving forward on a number of fronts. For example, workplace flexibility policies that help workers balance work and family obligations or that allow older workers to remain in the labor force. We are also considering other policies that would increase women's participation, such as paid parental leave and equal pay. Decreases in participation of young men of color have been a particular concern, and the president's launched the My Brother's Keeper initiative to help young men remain on track in school, complete post-secondary education, enter the workforce, and stay out of the criminal justice system. Supporting young men of color throughout their life stages will help connect them with the labor force and ensure that they reach their full potential professionally. Finally, building labor force participation, labor force attachment among young people can raise their labor force participation throughout life. An often overlooked policy to boost labor force participation is the President's Initiative for Preschool for All. For sure, this is not a rapid route to increasing labor force participation, but it is actually a tested one. And what we've seen is high-quality preschool programs like the Perry Preschool Program result in children growing up and becoming adults who are more attached to the labor force, who work more, who earn more, and are able to contribute more to society. The returns on these types of investments are huge, even if we do have to wait a little while to actually see them. More immediately, there are programs like apprenticeships and training programs that I'm sure you're going to talk more about in your last session today on structural reforms. So while the labor market's improving on numerous dimensions, even at a strong pace of recovery, the depth of the recession means that a full recovery will take some more time. And even after we're fully recovered, we should not expect the participation rate to recover to its pre-recession level. So let me end there. Thank you.
Thanks. Okay. Okay, so I now have the update, which is changed. With luck, after resetting everything in 5 minutes, the projector will work. If it doesn't, then you'll all have to plan on seeing the slides when they're put up on the web, because they are being saved along with the speakers, and so you'll be able to see them at a later date. Okay. Meanwhile, those of us who are sitting at this table and those who are just right there can turn around and because that screen shows it. Anyway, so I'm going to have to watch the time carefully here, but I'm going to turn now to Julie. Do you want to stand or?
There's nothing to show, so.
Right.
I mean, that's going to be even turned off now, right?
Yeah, that's going to be turned off for 5 minutes. Yeah. So.
Yeah, we'll turn the mic on. All right, I'm very disappointed because this was going to be my first Prezi presentation.
Is there somebody who doesn't have slides?
No, I didn't send any. I mean. Well, I mean, I can create slides from this, but.
No.
Oh, okay.
No, if you don't have any, then that's fine.
Anybody? Did you all have slides for your presentations? I did. I can go with that. Yeah. Well, I mean, it's up to you. Do you want to see a Prezi or not? No. No, I don't.
Julie,
if
you didn't have slides, then you should go
ahead. I do have slides. I do have a presentation, a visual.
Okay. Then
I can filibuster for 5 minutes.
Okay.
Or longer, yes. So, first of all, beginning with technology problems, I feel like I'm back at Brookings.
Wash your mouth out with soap.
And it's great to have the opportunity. This is actually the first time in my professional career I've had the opportunity to critique Betsy Stevenson on a panel. Usually we write together. So, the big question is, is there a puzzle about what's going on in the labour market right now? There are lots of different ways of framing this. One would be to say, is there more slack than conventional indicators suggest? The other alternative way, and in our models it's equivalent, would be to say, is there less wage growth than we'd expect given other things? And I want to make three arguments to prove I'm an economist. The first is that wage growth is definitely too low, suggesting slack is higher. And the second is that wage growth is probably about right. And the third is that wage growth is totally puzzling and we don't have a clue. So the first argument that wage growth is too low, suggesting that we may have more slack. So, the unemployment rate today is 6.1%. When I go to the CBO, they tell me that the natural rate of unemployment right now is 5.5%. I think the Fed tells me something roughly similar. So that says we're roughly within half a point of equilibrium unemployment. So the gap is very small. So we're at about a point where you expect the economy to be in the long run. Well, what do we expect the economy to do over the long run? Nominal wage growth, we would expect it to grow at the rate of trend productivity, so that's 1 to 2%. We probably want to add to that expected inflation, and the Fed tells us that that's 2%, so now we're at 3 to 4. And if you want to make a cyclical adjustment, you think the slope of the Phillips curve is about a half, because everything's a half. You multiply that by a very small unemployment gap, and it says that wage growth should be about 3 to 4% right now. And I think Chairman Yellen has actually said precisely that that's pretty much what you would expect in a non-inflationary steady state. By contrast, wage growth today is about 2%. So the employment cost index is running at 2.0. The average hourly earnings of private workers at 2.1. If you focus instead for, I'm not sure why, production and non-supervisory employees, it's at 2.5. And the median usual weekly earnings of full-time wage and salary earners is running at 0.8. So I increasingly read about the inflation hawks staring at the wage data, deeply terrified, and they appear to be deeply terrified that nominal wage growth is at or below their inflation target, even when we anticipate positive productivity growth over the medium to long run. So really this suggests either that we have a puzzle, why is wage growth too low, or alternatively it suggests we have more slack in the labour market than one would suggest, looking at sort of 6.1 and 5.5 as the natural rate. If you were way too courageous, you would look at wage growth and try and infer from that what the unemployment gap is. So if wage growth is currently running 1 to 2% below what it should be doing in the medium run, and the slope of the Phillips curve is about a half, that tells us that slack is 2 to 4 percentage points, which then, of course, tells us the natural rate is probably about 2 to 4 percentage points itself, which sounds a little too low. But at the very least, this calculation suggests that we're nowhere near running out of slack anytime soon. So that's the first argument, that wage growth is clearly too low. The second argument is that wage growth is roughly about right. And it's simply the observation that through the entire period from the last 25 years, nominal wage growth in the US runs between 2 and 4%. And it's done that almost every year. It's done that during periods of recession, it's done it during periods of recovery. And right now, wage growth is running at about 2 to 4%. And so we should stop being surprised when wage growth turns out to be running at about 2 to 4%. So then I think that leads to the third way of thinking about this, which is, the third argument I make to contradict the previous two, which themselves contradict each other, is that wage growth right now is totally puzzling. So if you, the standard framework we use for thinking about monetary policy in the United States is the Phillips curve. We all learned it in freshman or sophomore economics. You graph inflation against the unemployment rate. I'm actually in the midst of writing a Principles of Economics textbook, and I got to this point and I had to draw the Phillips curve. And I thought, you know what I'd do? I'd do something totally radical. I'd make the Phillips curve in my textbook empirical. Rather than have one of those stylized curves, I was going to use the data. The problem with this is when you graph inflation against unemployment for the United States over the past 50 years, you get just a cloud. They appear to be basically completely uncorrelated. I'm not quite sure what to do, because if we no longer believe in a Phillips curve, then I'm not quite sure what our operating framework for thinking about policy is. Now, it turns out there's a way of drawing that figure that does work for the United States, which is to look at wage inflation instead. So wage inflation, the rate of nominal wage growth, seems to be quite closely related to unemployment. I should say there's a third way of doing this, which is you run highly sophisticated models that have a whole bunch of controls, and you put in dummy variables for every embarrassing observation and period. And with enough of them, you actually do a pretty good job. But when you look at wage inflation, in fact, there's a very strong wage Phillips curve for the United States, at least for the post-1980s period. And so that's the context in which we typically do find that a 1 percentage point rise in inflation leads to about a half percentage point decline in nominal wage growth. But it's in that context you have to think about the last few years that we've been through. We've gone from a period in 2007 where the unemployment gap was either 0 or negative, to a period where the gap was clearly 4 or 5 percentage points. We had double-digit unemployment. And through that period, wage inflation basically didn't fall at all. We then had the subsequent recovery, in which we've gone from 10% unemployment back down to 6% unemployment, and again, wage inflation hasn't moved at all. And this is the first period in certainly in the last 30 years, in which we've seen wage inflation just refuse to have anything to do whatsoever with the level of slack in the economy. And so when you look at those data, I think you end up just feeling completely baffled and a little less sure about the frameworks we use for analysing these things. There is, to be sure, the positive interpretation of this, and this would be the Fed interpretation, which is if we have anchored inflation expectations, then we all know that inflation's going to be 2, so therefore we all know wage growth's going to be around about 3, so therefore none of us need to look at the state of the economy any time ever. And the breakdown of the Phillips curve is in fact a thrilling policy success. And I'm somewhat sympathetic to that, although I wonder why it doesn't show up in an equal fashion for the price and the wage Phillips curve. So the second, so that's where I think I'm at. Where are we with wage growth? It's either too low, about right, or totally puzzling, and we should stop thinking about it. And I think the second topic I wanted to talk about is this issue of how much slack is there in the labour market, and in particular, should we expect the labour force participation rate to rebound? The way we try and think about that is we look at the correlation between the labour force participation rate and the state of the business cycle. And if we found that the two were completely unrelated most of the time in most settings, then we wouldn't be worried that the recent recession would have knocked the participation rate around. We wouldn't think there was some cyclical part to come back. If, on the other hand, we found the two were quite closely correlated, then we would worry that it's possible. That seems to suggest that the state of the labour market could have a big impact, reducing the correlation, reducing the current labour force participation rate. So there's a very recent, I think, influential paper, and I hope Bill Washer's going to talk about it today. He gave it at the Brookings Papers on Economic Activity just last week, in which they sort of try and look at how cyclical is the labour force participation rate. And the most convincing evidence to my eye from that was they look across states. And so they look at, the problem with looking at national data is the US over the last 50 years has only generated 50 data points. The nice thing about having 50 states is we get 50 times as many observations and a whole bunch more recessions to look at. And they find they find evidence that's consistent with what Betsy Stevenson said a moment ago, which is that if you look at the current state of the business cycle, they measure it using the unemployment rate. Then for each percentage point that the unemployment rate goes up, the labour force participation rate gets suppressed by about 1/5 of a percentage point. And so that seems to suggest there's some possible effect, but it may not be large. Now, one needs to be a little bit careful with how one interprets this. If your preferred measure of labour market slack, the state of the business cycle, is the unemployment rate, we know the unemployment rate is just about back to the natural rate. And so if you want to try and measure the cyclicality, or this current cyclical effect on labour force participation, it's equal to the cyclicality times how big the business cycle is right now. Well, if you assume that the unemployment rate is round about normal right now, then any measure times 0 turns out to be 0. So if you assume that the unemployment rate is a good measure of the labour market slack, then you infer from these sorts of equations that given that an unemployment rate's round about normal, that the participation rate must be round about normal. But that's sort of assuming the question, right? And so I think what you need to do is, take something of a step back in thinking about this. Now, I will say, I think all of us realise that the labour market used to be dreadful, and now it's moderate. And so, given that, it's unlikely that participation rate is being distorted by a dreadful labour market right now. That's assuming that the relationship between the two is contemporaneous. I think if one wants to make the argument that labour force participation is currently being substantially cyclically repressed, one has to argue that what really matters for today's participation decisions is not today's labour market, but it's the labour market over previous years. And the interesting thing that Bill Washer and his colleagues find is, in fact, that labour force participation depends a lot on history. And it depends on the state of the labour market, not just today, but also they say all the way back to 3 years, and if you fiddle with their data a little bit, you can actually say all the way back 5 or even 6 years. Well, if you think today's participation decisions depend on the state of the labour market over the past 6 years, it's easy to say on average the state of the labour market over the past 6 years has been dreadful. And then I think it's a lot easier to start to believe that labour force participation today might be cyclically below where it would otherwise be. So I don't think I know the answer to this, but I think in trying to think about this slack question, I think one's view is really a question of how much do the lags matter. And that's where I think we need to spend a little bit more time and energy. Let me stop there.
Thanks, Justin. Okay, so we're having paper copies of the slides handed out, and these are for Julie's talk. So
I'm not sure that they are, but that's all right.
Oh, those were Justin's. Oh, okay. All right.
I'm not sure that they have. Anyway. I'll
Okay.
just carry on.
Okay.
Thank you.
You're welcome. All right.
So we do, we just smile and keep going. All right. I was asked to talk about the longer run view of participation. For those of you who can see any of these, I do, before I start, need to remind you that the views expressed here are not those of the Federal Reserve Bank of Atlanta or of the Federal Reserve System. And I think before, as we get started here, we need to agree about why we care about long-run trends in labor force participation. Depending on who you ask, our concern for the trends in long-run trends in growth in labor force either stems from what the heck those 16 to 19-year-olds are doing with their spare time, or it stems from a concern about fueling economic growth. I have a chart in the handouts that you may be able to pick up later that shows the long-run growth in the total labor force since about 1949. And we see in that chart that up until the end of about the 1970s, there was increasing growth in the trend in the total labor force. And since that time, however, total labor force growth has been consistently declining. So the first thing to take from that chart is that the declining trends in labor force growth has been going on for quite some time. It's not merely the result of the Great Recession nor of the baby boomers retiring. And if we focus on the second part of that graph, we can also see that there's a significant cyclical component, as Justin mentioned, to these overall long-term trends, so that during expansionary periods we see these spurts of growth coming out of recessions, and you'll also see that the current spurt, if you will, in labor force growth is right on par with those coming out of previous recessions, although it's starting from a much lower point. So if the long-running trend in labor force growth is a concern, and we're interested in policies that might affect or either sort of stem or reverse the trends in declining trends in labor force growth, then we need to talk about the factors that make the greatest contributions to the changes in labor force. And so from a purely algebraic perspective, there are just two factors that contribute to changes in the labor force: population growth and changes in labor force participation rate. And so if we think about the year-over-year change in the total labor force that you didn't see, then we can decompose that change each year into the contributions that are made by changes in population and contributions that are made by changes in labor force participation rate. And the striking feature of that particular picture, imagined in your head, is that historically, changes in the population have been the primary contributors to changes in the growth or changes in total labor force. There are three exceptions. 1956, I'll let someone else explain that one, but then more recently, 2009 through 2011, contribution of changes in labor force participation rate have been larger to changes in the overall labor force than changes in the population. And there, of course, have been some concerns expressed about these declines in the labor force participation rate that has continued to pull down growth in the labor force. I'm putting up a chart that shows this dramatic decline from 1999 through 2014. And there's been a lot of people who have tried to identify what have been the strongest contributors to this change in the total labor force participation rate from before to after the recession. And the typical approach is to take data from before the recession and project where labor force participation rate would be after the recession if the recession hadn't occurred. And so if you just use demographics to make that projection, you get a line of projected labor force participation rate that falls somewhere above the actual labor force participation rate. And that's what we all generally agree is structural in nature, primarily the result of changing demographics, primarily the aging of the population. And so then you take the difference between what labor force participation rate was before the recession to what it would be projected to be, and that's your structural portion of that change. And then the difference between that projection and the actual then is just attributed to the business cycle. Work that I have done in this area takes a step further and models the impact of the current recession on changes in labor force participation rate. And I find that the business cycle, adding the business cycle to that projection, that labor force participation rate would have actually been lower if behavior hadn't changed in order to prop up the labor force participation rate. So an example of the difference between behavior and demographics might be, for example, that women today are having fewer children than women in the past. That would be a demographic change. And sort of counter to that, or the behavioral part of that, is that women with children are working more today than they were historically. In addition, the population is aging. That's a demographic change. Older people are working more. That is a behavioral change. So there's an important distinction between behavior and demographics. Behavioral changes are harder to classify as either structural or cyclical, but they are important because they're malleable. They're able to be affected by policy. And so if we think that there is slack in the labor market and we don't consider the possibility of affecting behavior, then we're going to be addressing this problem of slack with one hand tied behind our backs. Now, there are a number of policy options that can be used in order to either stem or reverse this trend. And the policy of choice will be whether or not you believe there's labor slack in the labor market or not. In a minute, I'll talk about the contributions and the policy options related to affecting labor force participation rates. But first, let me talk about contributors or policies that might affect population growth, because historically, that has been the biggest contributor to changes in the labor force. The primary and likely most effective tool for affecting population growth, in the short run at least, of course, is immigration. In addition, there's some evidence, although it's not uncontested, that tax policies, such as the child tax credit, can affect fertility decisions. Now, of course, that policy option is a bit longer term in its effect. But now turning to labor force participation policies, there are three demographic characteristics that are among the most highly correlated with participation decisions: a person's age, a person's education, and a person's immigration status. So the highest rates of participation are among those between the ages of 25 and 54, after, of course, formal schooling has completed and before Social Security or retirement kicks in. Of course, there aren't any policies that can keep people from aging. We could, again, through immigration policy, target those age groups that are more likely to participate in the labor market and affect the participation rate in the population. More highly educated people are more likely to participate in the labor market. Now, while I question whether or not there's any sort of causal relationship here, if there is one, we could provide incentives for individuals to undertake an investment in graduate education, which as a result would have them work more in order to recoup the returns on that investment. And immigrants have a higher participation rate than natives. So again, through immigration policy, we could positively affect the participation rates in the population. As we saw, or as you know, labor force participation has a very strong cyclical component. And so related to that is a person's expected wage. A person's expected wage is the probability of finding a job times their market wage. The expected wage of any person in the labor market on average is lower in a weaker labor market, primarily because the probability of finding a job has declined, and that increases the chance that the value of some other activity exceeds the person's expected wage, reducing participation. Now, by undertaking policies to stimulate economic growth, the labor market strengthens, increasing the probability of finding a job, and thus increasing a worker's expected wage. In addition, as technology increases, workers become more productive, increasing their market wage, increasing their expected wage, and workers participating more as a result as well. Now, I mentioned earlier another set of policies worth considering if you believe that there is slack in the labor market, and those are related to individual behavior. The presence of children is consistently one of the most important factors determining labor supply behavior, particularly of women. Any policy that lowers the fixed cost of participation, especially as it relates to the care of children, will significantly affect participation rates. Now, retirement, like death and taxes, is something that we can count on. And so we also know, related to retirement, that those decisions to retire respond significantly to incentives. Shifts away from defined benefit to defined contribution plans, loss of wealth through stock market crashes, and adjustments to Social Security policy have all had significant impacts on retirement decisions. All right, so where you stand on slack is important in choosing the right policy for affecting labor force growth. If you believe there is slack in the labor market and you want to entice those untapped resources to enter the labor force, then policies that manipulate incentives are where you want to focus. Increasing a worker's expected wage through economic growth and/or wage growth, reducing fixed costs of employment, improving incentives for workers to delay retirement. These are all about incentives. Now, if you don't believe there is slack in the labor market, but you still want to stem the decline in labor force growth, then your focus should primarily be on those policies related to increasing the human resources available to your economy, which will point you in the direction of immigration and with perhaps some fertility tax policy thrown in. All right, so let me summarize the things that I think should guide the discussion, because again, I don't have any answers either, but I have some things that perhaps we should think about while we're trying to get to some answers. The slowing labor force growth threatens economic growth, and this is the primary reason that we care about the declining labor force participation rates. Labor force growth has been declining since the 1970s, so it's not merely a phenomenon of baby boomers retiring or of the most recent recession. The current cyclical component of the labor force growth appears to be on track, although again, it's starting from a very deep trough after the most recent recession. And population growth has historically been the largest contributor to labor force growth, but there have been concerns recently about declines in labor force participation, prompting endless debates about the contributions of demographics, changes in demographics, labor market strength and behavior as contributors to those declines. And then finally, there's a myriad of policy options for arresting this declining growth in the labor force, but policies affecting incentives should be the focus if you think that there's a considerable amount of slack in the labor market. Thanks. Thank you.
All right, next, Michael Kiley, Federal Reserve Board.
All right, so thanks for having me this morning. A couple introductory remarks. I'm going to talk about a narrow area of some of the discussions today, and in particular on the relationship between short and long-term unemployment and price inflation. My discussion reflects my own views and not those of the Federal Reserve or its staff. And I'm going to structure my discussion to start with a general overview of the issues, but then to dig down more specifically into a research paper focusing really on methodological issues of how one should approach this question, and then see what that approach implies for the underlying relationships, and then return to the broader literature. So as others have said, Betsy mentioned it, Justin mentioned it, right? Long-term unemployment increased dramatically in the most recent recession. At the same time, price inflation has not fallen by as much as some would have expected. And currently, short-term unemployment has returned to what some might consider to be a normal level, while long-term unemployment is elevated. This confluence of developments has led some to ask whether, in the United States, long-term unemployment is relatively unimportant for wage or price pressures. Certainly there are theoretical reasons why that's an interesting question and one that we should seriously consider. One can write down models, or perhaps more accurately stories, of why the long-term unemployed may be relatively weakly attached to the labor force, and that marginal workers determining wage and price pressures are those who are more recently unemployed. Perhaps more interestingly, recently there have been a lot of empirical studies coming to the conclusion that perhaps actually in the U.S. data we finally have some observations that can differentiate between the effects of long-term and short-term unemployment, and that in fact the effect of long-term unemployment on inflation is relatively muted or completely non-existent. On on my slides, I present an example of this research, which I think is pretty representative. So I reproduce a regression in a paper from Glenn Rudebush and John Williams. They estimate a standard Phillips curve over the period 1960 to 2013. The only thing that's relatively different is that rather than include the total unemployment rate, they include the short-term unemployment rate and the long-term unemployment rate. If you look at that regression, lo and behold, the coefficient on short-term unemployment is something like a quarter. That's a nice round number, perhaps not as nice and round as a half, but easy to keep in mind. And the coefficient on long-term unemployment is 0, basically 0 to decimal points. And the coefficient on short-term unemployment is very, very significant. If you look at the standard error, the coefficient on long-term unemployment is, I guess, somewhat imprecisely estimated, but perhaps at conventional significance levels, you might say, really there are differences across these two measures of unemployment in generating price pressure, and that short-term unemployment is the right measure. Now, in thinking about, and that's a conclusion that's been reached by quite a few studies looking at taking this Phillips curve approach, looking at aggregate data. Now, why might you have concerns about that approach? You know, the t-stats are big, they're different. Well, if you look at the equation, right, we kind of know that that equation is a mess. We have economic reasons to think that the lag structure and the coefficients on unemployment actually shouldn't be the same over time. We seem to see an anchoring of inflation expectations that has fed through to the coefficients on lags that affects estimates on the other coefficients. Research has demonstrated that changes in monetary policy should have profound effects on the coefficients of slack in a Phillips curve. After all, a Phillips curve is a reduced form relationship, not a structural relationship. It's capturing dynamic patterns in the data, not underlying structural relationships. That large body of research suggests, well, you should dig a little bit under the cover when looking at those aggregate time series regressions and ask simple questions like, are they stable? If they're not stable, do the coefficients look a lot different over different time periods? And in fact, if you were to do standard statistical tests, the coefficients are not stable and the coefficients look really different over different time periods. And in particular, the coefficients look very different over the post-Volcker period relative to the pre-Volcker period, exactly as our macroeconomic models of what should determine the shape of the Phillips curve predict. You know, this is something that's been found in many previous studies. So then if you repeat this sort of aggregate regression, and that's something I do in a paper or in a slide that you can't see, you know, over the last 25 years, the coefficients on short and long-term unemployment aren't very different. Certainly not in a statistical sense, and depending on what else you include in the regression, they're not even very different if you look at the absolute magnitude of the coefficients. But what is really apparent is that the regression says I can't tell the difference between these two variables. The standard errors are huge. Now, why should that be the case? Well, there's a graph of the total unemployment rate, short-term unemployment, and long-term unemployment in my picture, and you can see a couple things in that. For example, you can see the observation that Betsy made that there's an upward drift in the share of long-term unemployment in total unemployment. But the overall impression one gets from that picture, especially if you don't include the last few years, is, gosh, these variables move a lot together. They're really, really highly correlated. And in fact, we only have one observation, the recent recession, in which there seems to be different movement. Well, when variables are highly correlated, and here's where we get into the methodological part, we know that regressions have a problem, right? So if two variables are perfectly correlated, they may actually have different effects in some imaginary world in which they were to move differently, but you could never tell because it doesn't happen. And it happens to be the case that for short and long-term unemployment until 2007, that's about what the data is saying with regard to price pressures. You can't tell the difference. Now, this is an observation that others have made before. So Larry Ball in a paper a few years ago said, well, you know, we might actually have enough evidence in coming years to finally differentiate and be able to tell whether short and long-term unemployment have different effects on price inflation, because we have seen in recent years some different movements in these variables. What I do in my paper is take that proposition seriously, look at a characterization of the data, simulate the data lots of times and say, how much data would I need to tell Well, if I get a couple extra years, will I ever be able to tell that these variables are different? And, unfortunately, a few years is not that much data. As Justin said, 50 years isn't actually that much data. And so adding a couple years onto a Phillips curve regression just is unlikely to help in this differentiation. So then I ask, okay, well, what might help? So certainly if you think U.S. experience is similar to that in other countries, looking at experience in other countries might help. Perhaps a more direct way is to note that the U.S. is not a homogeneous labor or product market, and there may be regional factors that affect price inflation, and estimate Phillips curves across regions. Now, that's not a trivial step to take, right? You need to have a structural model of why you think, product prices, for example, if you're thinking of price inflation, are not determined by national factors. What elements are non-traded? How are local labor conditions important for that? But if we put those issues aside, I explore a possibility through some Monte Carlo analysis, and indeed confirm that, while you're unlikely without essentially hundreds of years of data to be able to tell from a national regression the difference between short and long-term unemployment, if you have a lot of regions, you can get hundreds of years of data a lot more quickly, even if there are important national components to inflation. So with that sort of statistical motivation or methodological insight in mind, I turn to regional regressions and indeed find that over the last 25 years, the Phillips curve is a strong relationship. So there's a very strong relationship between labor market conditions and price pressures across U.S. regions. In addition, regional factors seem to be really important. So looking at the national unemployment rate is insufficient for understanding regional variation in inflation. And then finally, the coefficients on short and long-term unemployment are much more precisely estimated and essentially equal to each other. So they end up, I don't have the table in front of me. I think one ends up being exactly a quarter, and one ends up being 0.27. And the standard errors are tenths, are less than tenths, not multiples of tenths as in national regressions. So that leads to the conclusion that you certainly couldn't reject the hypothesis that these are equal determinants of price inflation. Of course, not being able to reject a hypothesis is not the same as accepting the hypothesis, but the sort of statistical evidence that's been provided in previous studies using a Phillips curve approach really is pretty unconvincing and I think not helpful for answering this question. And if you look at take the data seriously, try to expand your sample, you certainly could get yourself comfortable with the notion that short and long-term unemployment, at least in the United States, do not have differential effects on price inflation. Now, subsequent to my analysis, a variety of others, subsequent and concurrently, a number of others have looked at the issue in a similar way, perhaps not taking as much of a methodological stance as I do. I really spend in my paper most of the time talking about why this is a tough problem and why the econometrics suggest you need to take a different approach. But other people who've just looked at the data, I think, have often come to the same conclusion, whether looking at price or wage inflation, that if you look across regions, regional factors are really important in determining inflation, and that at least in the U.S. labor market, there's not much distinction to be drawn between the inflationary pressures delivered by short and long-term unemployment. Obviously, this issue has some bearing on an assessment of overall slack, given the current state of the labor market. In addition, the thing that I personally get at least as excited about is it reminds us that the Phillips curve is a reduced form relationship, and you need to think hard about why the data should look a certain way, what sample you should be looking at, and the power of the statistical tests that you bring to bear on these questions. Running a regression and fortuitously finding, probably after running many regressions, that you have a big t-stat on one and not the other is not dispositive evidence.
Thank you, Michael. So.
Let me just take a moment to apologize unreservedly on behalf of the Institute to our panelists, particularly, I think, Betsy and Julie, who were really caught. We haven't had this problem for a while. Brookings' analogies are not justified. But we are now making up for it by expanding our carbon footprint, and hard copies of all the presentations are being quickly printed out by our team and distributed, and I think we're caught up now that actually Danny's presentation is there in hard copy for everybody. Thank you for your understanding.
Thank you, sir. Well, thank you for this. I guess in comparison with Betsy and Justin and Julie, I guess I'm a cyclical guy. I think a lot more of this is cyclical, and I'm going to talk about why. I come to this issue, I have to say, for about the last 30 years, and many of the issues we're going to talk about, and Michael correctly talked about the long-term unemployment issue, been there, seen it, done it. I'm going to talk a bit more about that. A lot of what I'm going to talk about today, actually, relates to trying to put an international perspective on this, because many of the issues are actually the same, and some are quite different. And I'm going to focus on the fact that the commonality of all of this, particularly in the comparison between the US and the UK, which I'm actually going to spend some time thinking about, is actually wages. And the paper that you have actually by Adam and myself today talks about the huge amount of downward pressure on wages from a variety of sources. And we talk about the need to focus on, for the Fed to focus on wage pressure. I'm going to talk more about that. But I just want to put this in context. I think there is a huge puzzle that's going on. And if I was to have sat in this room, let's say in 2007 and 8, and I look back at every regression I ever ran, and Bill might have argued with me, but we could probably, there's a similarity here anyway. I would have probably said in 2008 that the wage curve that I'd written about, the effects of unemployment on wages in the US and the UK was about the same, roughly. My minus 0.1 rule would work. Well, since then, we have a big issue here, which I think is a huge puzzle which I don't understand, which is since 2008, and particularly in recent time periods, in the UK and the US, unemployment rates have fallen pretty much together, sharply downwards over the last year or so. And today, the unemployment rate in the UK and the US is basically the same. Turns out also that despite all the things we talked about the declining participation rates in the US and the UK, today, roughly, the participation rates are the same. Except that over the last 20 years, and we've looked at the series today and we've talked about the decline in the US of the participation rate, I can almost exactly plot for you a line which does exactly the opposite in the UK. Strongly rising participation rates with many of the same issues people talked about women going back to work and childbearing and all the rest of it. So a common set of issues to both countries probably doesn't explain it, because in one country it's up and the other one it's down. The one thing I'm going to start from particularly is this puzzle which I have in my head and I don't think I have an answer to. Since May 2010, real wage growth in the US is flat, basically. In the UK, it's down 10%. Real wages are down 10% since May 2010, and they're currently falling at about 1.8%. So we've never seen anything quite like this. But I'm going to talk about the commonality between them. And in reality, obviously, these issues are big ones, and I think there are many puzzles to be had. And I don't have a story, and I don't think anybody else does, as to would I have said in 2008 that UK wages were much more flexible downwards than US? I don't think I would have. And so that's where I'm going to start from. The paper that Adam and I have done, and it's released today, and you have a copy of it, in that paper we actually show with state-level data, state year panel, we show that, go back to the old wage curve stuff that we did, and I'll show you some of the regressions in a sec, that works just sort of hunky-dory. But actually, the inactivity rate also enters strongly, significantly negatively in those wage equations, pushing down on wages, hence the story I'm thinking about in terms of much greater cyclicality. Also entirely consistent with everything that Michael talked about, we actually find absolutely no evidence whatsoever of any effects of long-term unemployment. And this is actually kind of interesting because I was brought up as a graduate student at the LSE in the 1980s, and we spent most of our days there talking about long-term unemployment. We talked about it because we had it, and you didn't talk about it because you didn't have it.
No effects, you mean no different.
Oh, yes, correct. Thank you. Yes. I'm just going to. Sorry, no different effects from the short term. I'm sorry, correct. And actually, we went and looked at these issues in Andrew Osborne and I wrote a paper in 1990 where we actually looked at the effects in the UK at that point. And what we find, so Adam always says, I get this, I don't say it right, but we mean the same thing. We find no evidence that the long-term unemployed have a different impact on pay than the short-term unemployed. We wrote that in 1990, and everything that I see today in the US is completely consistent with that, because it looks like the US is almost exactly like the UK was before and is now. And we find, in work we've done, we find no evidence at all either for the UK that that's true. So that's completely consistent with what Michael said. There's papers by Smith from the Fed that finds the same thing. I'm going to show you a couple of regressions in a second. The one thing I'm also going to talk to you about is the fact that, despite the fact that I said inactivity rates in the UK didn't move in the same direction, that doesn't look like an additional measure of slack because the participation rates are rising. So something we have to think about, same unemployment rates, what the heck is going on? I'm going to talk a little bit about the fact that we have a lot of evidence now, and I'm glad I've got Erica here because I want some questions for her to put into the survey, and I'm going to tell her how great they are. But you'll see why they're great. Okay, so this is really the paper. If people have got the paper, I think the handout's coming round. Let's just quickly, please, go to, this is table 4 in the paper. It's the first set of wage equations, and I think this is really the first part of the story. This is the paper with Adam. This is the first part of the story that says this is really all about the participants. I think of the non-participants actually sitting there ready and willing to step back into the labour market and find work. And that's what this suggests. And actually, I think if you look in the paper, we talk about the fact that actually quite a lot of the slack, both in the UK and the US actually, a huge amount of the slack are the young. And if you look in the data, it's actually, I don't agree with Betsy's estimate. I think they're much larger than that. I think the young are they've left and they've gone to being students and unpaid internships and stuff, and they're going to step back in. So essentially what you have in these equations is you can at a state level panel, you run wages on a lag wage, state fixed effects, year effects, and controls, all kinds of controls generated from the CPS. And basically you get a nice wage curve, you get unemployment entering the wage equation. But for the first time, and Andy Levin was the person who, at a conference some time ago in Boston, said that this would happen, and I stood up in the audience and said he was wrong, and about 2 months later I had to call him up and say, oops, you were right. Anyway, so that's true in both hourly and weekly wages. If you go to the second table, that's table 5 in the handout, turns out that we can do all sorts of experiments. So in everything we get a wage effect from the unemployment rate, we get an inactivity rate. So it turns out if you measure out the size of the effects, it's about a third. The change in the inactivity rates has an impact on wages about a third of the size of the change in the unemployment rate. But that's just suggesting to you that the reason the wages are being pushed down is because these inactives are actually pushing down. If they weren't there, if they weren't really prepared to come back to the labour market, you wouldn't think they'd be putting downward pressure on wages, which is what they're doing. And we actually, in this table, actually have some evidence, and I think Michael has actually got a similar kind of evidence. We basically find very little difference between the short-term and the long-term unemployed. But if anything, and he has some regressions showing the same kind of thing, if anything, we actually get the opposite. We even get a negative sign in it, which tells us that actually they have greater downward wage pressure than the others. So if anything, I'm not saying I'm going to push that. If anything, that's true. So in the US context, I think, and I'm obviously doing a lot more on that, we think that that's happening. And we've now started more projects trying to think about what else might build into that slack. And Andy and I are doing some work. He's going to talk about it a little bit later. And we actually can show you as well now that these underemployment variables, in addition, enter into these equations. Things like the proportion of part-time for economic reasons enters. But what's quite interesting, just like the inactivity rate, it looks almost orthogonal to the others. So if you looked at the tables we have here, you put the inactivity rate in, the unemployment rate coefficient doesn't really move at all. How am I doing for time? I'm on track, I think. 4 minutes, I'll be good, I'll be there. The thing I'd like people to think about actually is what happened in the UK, and we actually get similar kinds of things going on, but the big difference with the UK, it's not about the participation rate. The big thing in the UK actually is, in fact, we've had a big rise in the underemployment rate. I was very struck with Betsy's chart. I've always looked at U3 and U6, and roughly they look like they move with a constant. Not exactly, but roughly. But we have this great series in the UK, which is sort of a set of papers that I give references to them. We have a great set of questions in the UK on the equivalent of the CPS, starting in 2000, where we ask people, would you like to change the number of hours that you work at the going wage? If the answer is you'd like to increase them, tell us how many you'd like to increase it by. If you'd like to decrease them, tell me how many you'd like to decrease it by. And in some sense, this is a rewriting of the part-time for economic reasons. But we actually, I'm going to tell you that actually we get a third of the slack we identify comes from full-timers who also say that they would like extra hours. So obviously the part-time for economic reasons excludes those people. Okay, but here's what's really interesting. If you look at the table, it's in the chart here. What's really interesting is actually think of what equilibrium in these tables are. Between 2000 and 2008, these two series are equal to each other. Good old labour market stuff. You know, the people can move around. There's plenty of jobs going around. You can adjust your hours as you like. So equilibrium is basically from 2000 to 2008, flat. From 2008 on, the series saying would I like to work less hours roughly remains, a bit squiggles, but roughly remains flat. And this series, would you like more hours, takes off. It's roughly equivalent to about another 2 percentage points on top of the unemployment rate. That's moved a little bit with it, but the things have separated. And it looks like in the UK that underemployment series pretty darn much explains the non-inflationary changes that we're seeing. The nice thing about this is these people are asked at the going wage, what would you like to do? Yeah. I'm sorry, it's okay. I'll give you. I'll take this one. There it is. Look. Sorry. So here's the chart that you. So.
But it's not what we have.
Okay. Well, there's that chart.
Oh, you guys have.
Okay. So you can see that if you just track it to the unemployment rate, this is a variable. So this tracks in many senses the two countries. It looks like underemployment in the UK is the big deal, pushing down on wage, but hugely pushing down on wage. I don't have a great story for that. I've been very critical, actually. It turns out that the MPC has actually been reducing by hand the scale of the unemployment rate. It's decided, contrary to all the things we say in this room, that actually what it will do is it will take off a chunk of the unemployment rate because of long-term unemployed, despite the fact that they have absolutely no evidence that the long-term unemployed are different. Second, what it does is it's actually taken off. It's said, yes, we'll accept some of the underemployment that you've talked about, Danny, and they publish it as it's part of the inflation report, but we'll just halve that. So all their predictions have actually been that wage growth is going to grow strongly. They've been predicting that for the last 2 years, and every time they predict it, wages fall further and further. So it certainly does look that the level of slack is much greater than they think. So in both countries, you have these levels of slack suggesting lots of cyclicality going on. I'm giving you, obviously, my approach to this, but I don't think I have the great answers. Who would have thought that real wages in the UK will be down 10% in 4 years? So my conclusions, more cyclicality than other people thought. We find no evidence at all that wage growth is about to take off. There's a lot of downward pressure on wages coming from the unemployed, from the non-participants, and from the underemployed. We find no separate effects for long-term unemployment. And I think the way to summarize all this work we've been doing is the unemployment rate doesn't appear to be a sufficient statistic for us to model the labor market. We need to look at other things. But these things, particularly in my UK context, you can see, and Bill and I were talking about this a little bit yesterday, prior to 2008, certainly in the UK, the unemployment rate was a sufficient statistic to tell you about what was happening in the labour market. Because if you wanted to add the underemployment rate to it, you added 0 to it. But of course, since that time, it turns out it's not a sufficient statistic at all because you've got other stuff you've got to add to it. So I think that's the way I would conclude from it. Lots of downward pressure, unemployment rate, not a sufficient statistic. And I see no evidence whatsoever that wages are about to take off. Thank you. How do I do for time?
So we have about 15 minutes for discussion, and I'm going to, first of all, thank all the authors particularly for carrying on despite the lack of slides. So that I think we got the gist of most of what you had to say. And let me start off by giving everybody else on the panel the same opportunity that Danny just took. I'd be really interested in what other data we'd need to begin to resolve some of these questions. And also, understanding how important is it for us to continue to produce the data that we're already producing. So, let's see, I'll start with Betsy, yeah.
Great. Well, I was actually thrilled. I think one of the reasons why we were grappling around trying to find Danny's chart is I think he put his finger on a question that we'd really like the answer to in the U.S. context, which is how many workers who work over 35 or 35 or more hours actually feel that they're underemployed. We are all, I think, struggling to understand the rise in part-time for economic reasons. And as I've investigated this data, I've left scratching my head and wondering, so if you work 34 hours, we ask you, do you wish you had a different job? Do you wish you had a full-time job? And we give people a chance to express displeasure with the current job they have. If you work 35 or more, we don't. So, if I think just to put this in a concrete way, if you're a college graduate working at Starbucks, and you work 32 hours, we know you're in the wrong job. If you work 35 hours, we don't know you're in the wrong job. So it's not even just about asking about more hours, but trying to figure out whether people are in what they consider a temporary makeshift job or if they're in sort of the right job for them, I think would be useful to know. One other thing, and I'll say this as an academic, not an administration official, although in my capacity at CEA, we think about this as well, is like longitudinal data is so very, very useful to understand what's happening with people over time. And I know represents one of the biggest challenges for our statistical agencies.
I'll follow up on that, and in addition to those data hours, I would add that any access or easier access to administrative data would certainly be something that would be useful as the response rates to surveys continue to fall. And Erica knows this. So I'm not saying something she doesn't already know, but I just want to encourage people to be thinking about how open we can be with the data that we collect for other purposes and how it might be used to answer some of these labor market questions.
No, we're doing it in order.
So I suppose I'll play to my comparative advantage and not talk too much about the data because I'll just embarrass myself, but rather talk about categories of data to look at in assessing slack in the economy. So I think the standard that a macroeconomist like me starts from is looking at a Phillips curve and an Okun's law relationship. As my talk hopefully illustrated, the Phillips curve can be very unreliable. It's not particularly stable over time. There are lots of other developments that can help us inform our assessment of the state of the economy. So, for example, fluctuations in other variables, the credit cycle, for example. In a paper earlier this year, looking at an Okun's law, a Phillips curve, and a credit cycle variable, if one were to look in quasi-real time at a period like 2004 to 2006, inflation would have been telling you, well, look, maybe the natural rate of unemployment is under 5. But if one were to look at the historical position of the supply of credit, one would say, gosh, this is a really unsustainable position. I'm taking those cyclical relationships into account. The natural rate of unemployment, even in real time, would be estimated something more like 5.5. So I think broadening our framework to focus not only on the Phillips curve, it's just not as helpful as we would like it to be to think about slack.
Justin.
I want to echo something Michael Kiley said before. I think the biggest data shortage we have is we only get one new business cycle every 7 or 8 years, and so really we're working with 3 or 4 data points. So I do want to thank, I guess, Chairman Greenspan for creating more data for us. But so given that shortage, and particularly this important question of the role of long-term unemployment, the only 2 places we can look for that are do exactly what Michael has done and look down at the state level, or go overseas and start looking instead. And what's interesting is the juxtaposition between the two. When you do what Michael has done, and you look at MSAs or states, it looks like the long-term unemployed matter just as much in the United States as the short-term unemployed. When you go over to Europe, and particularly the European experience during the 1980s, you have to be drawn to the conclusion that the long-term unemployed became completely irrelevant, or else you have to believe that somehow the natural rate of unemployment in Spain was 20%. And so I think drawing those two together is interesting. The second thing I want to do is less a pitch to Erica, the collector of data, and more a pitch to Michael, the economic theorist. There was a time the Phillips curve was an empirical relationship. Bill Phillips, the New Zealander, drew a graph between the change in wages and the unemployment rate. We macroeconomists have become sufficiently sophisticated now. The Phillips curve is the relationship between unemployment relative to something unobservable, the natural rate, and versus inflation relative to something unobservable, inflation expectations, all mediated by a slope, which is mediated by something else unobservable, the extent to which inflation expectations are anchored. So the Phillips curve, it's now a relationship between 2 unobservable variables mediated by a 3rd unobservable variable, which either makes it profoundly true or profoundly false, but I think none of us really have a clue.
Okay, Danny.
I don't agree with anything about the long-term unemployed that you said. All the evidence is actually in Europe from all the empirical work that actually, once just as Adam said, that the long-term unemployed and the short-term unemployed have exactly the same effect. So I don't agree with that at all. One of the things I'm actually quite interested in, it turns out, particularly in a place like the UK, is actually trying to learn more about the self-employed. Because we've been talking about wages. In the UK, it turns out that the national statistic excludes all workers in firms under 20 and entirely excludes the self-employed. But we do actually, in this series that Betsy was talking about for the full-time too, we actually have evidence certainly now that prior to 2008, the self-employed were kind of happy with their hours, and now they're really, really unhappy. But we have very little clue about what's actually happened to their earnings. The shock in the UK was that we just had a small survey came out with the latest estimate, and I told you about the fact that 1.8% is the drop in earnings of people in firms of greater than 20. What about new firms? What about small firms? But the real wages of the self-employed in the UK in the last time period fell 14% in a year. So I think that what's happening to the self-employed, especially if in this time period people are being pushed from, they're being pushed from employment to unemployment to some kind of low-paid self-employment. So I think the earnings of the self-employed is obviously important, and obviously we know we have a little bit of it in the marches, but I think the self-employed is a really big thing we need to try and understand about.
Okay, now we have some time for questions from the audience. Maybe the best thing to do is to take a few questions and then have some responses from the panel. So I think there's a microphone back there, right? And there's also a hand. Okay. So we have one up there and over there. Okay. So go ahead, please.
Hi, Chris Rugaber at the Associated Press. Just a quick question for Professor Blanchflower. What is your research, if you're looking more at the cyclicality of long-term, of the LFPR, what does that imply for the rate in the future? Do you expect a bigger rebound in that figure? Thank you.
Yeah. Let me take a couple more
questions. Please, of course, please.
But write it down. Okay. Another one over here.
Yes. Hi, I'm Andy Levin. They're great presentations. I actually was intending this to be a question for Justin, but maybe it's also a question for you, Erica. Mm-hmm. There was a very nice poll done this summer by Reuters. I didn't think it got nearly the amount of attention it should have. It was an exclusive Reuters poll conducted between June 6th and August 8th. Shows that many retired and other jobless people who have stopped looking for employment declaring that they're ready to re-enter the labor force if the right opportunity came along. It was a poll of 7,700 individuals aged 18 and older. 34% said they had stopped looking for work because the job market was so bad. Despite the falling unemployment rate, 40% said they were no more optimistic about their job search today than when they initially stopped working. I think that's Justin's point about the lags. You know, maybe there's been some improvement lately, but some of these people may not be as aware of it, or the unemployment rate is exaggerating the improvement. Among those who said they'd halted a job search, many were ready to resume the hunt if they received the right signals from the market. Those signals included more job postings to match their qualifications, evidence of a stronger economic recovery, and word that friends or relatives had landed jobs, which again, it connects up to Justin. How do people get information? It's because, now the question for Erica is that one of my frustrations the last few years is that marginally attached and discouraged refer to people who've searched for a job in the past year, which in normal times is probably a good way of thinking these people are still, they haven't searched in the last month, but they're still marginally attached. The issue we've faced in the last 5 years is that we know from Pew Foundation work and other studies that people have been out of work for years. They're full-time parents, they're doing other things, they went back to school. That marginally attaches isn't a good measure of it. And so an obvious thing I think to do in this survey would be to follow the Reuters example and ask people, even if they haven't been working for quite a while, and maybe using some words that Betsy said, what would it take to get you to come back, sort of questions. It also connects up to what Julie said, sort of what kind of incentives. Another policy she didn't mention, or maybe she did, was about childcare programs. There's lots of room for improvement. But again, this seems like an urgent area. Maybe it could be done in the next March supplement. If we don't change these surveys until 2020, it will be too late to inform these questions, and these are urgent questions for policymakers now.
Very interesting. Any other questions? We've got one more there and a couple here, and then we better start answering.
I wanted to ask Danny Blanchfeld to elaborate a little bit on the idea that long-term unemployment in Europe was just as effective in holding down wages as short-term unemployment in the 1980s, 1990s. Why didn't we see bigger declines in real wages in Europe in an environment of very, very high unemployment, if that was the case? Just the basic facts, without looking at any micro data, would suggest that long-term unemployment wasn't that effective to me.
Okay, we have a question back there.
Thanks. Ernie Tedeschi from ISI Group. One thing that I didn't hear mentioned, but that Janet Yellen mentioned in her Jackson Hole speech, in terms of the wage data, was the possible role of nominal wage rigidities in explaining the breakdown in the relationship. And just empirically, I think the San Francisco Fed has a wage rigidity index where they've longitudinally linked CPS data, and they show that there are elevated number of job stayers that have not received a nominal wage increase over the past year. So to what extent do you think that sort of, during the recession, not getting the wage cuts that would normally be expected and now pay back, not getting raises that might be expected, explain some of the breakdown in this relationship? Thanks.
Mm-hmm. Okay, and one more question, yeah.
Jacob Kierkegaard from the Peterson Institute. Just a quick question for David about this notion that so many more in the UK wants full-time workers want higher hours after 2008. But isn't that basically a function of the levels of inflation in the UK? I mean, isn't it perfectly rational that if you have suddenly 4 to 5% levels of inflation, that even if you work full-time, you want higher wages? And so I'm just wondering if you add these kinds of things into the slack, don't you get something that's basically highly correlated with inflation?
Mm-hmm. Okay. So Danny, a lot of those questions were for you, so maybe I'll let you try and summarize a lot of answers quickly.
I expect labour force participation rates to start rising again, especially for the young. And I have an instructive movie. It's called The Full Monty. Don't know if you remember it, but those people were actually out of the labour force, been out of the labour force for a very long time. I won't spill the beans as to what they do, but they'll do almost anything to get themselves a job. And I think that's the first thing. Second thing, a lot of the work that was done by Laird and Nicol and others on time series data, and there's a paper by Andrew and me in 1990, which basically shows that what happens when unemployment gets really, really high, perhaps in the orders of double digits, things alter. My view in all of that stuff was that there were other explanations, but long-term unemployment is correlated with high unemployment. And it's high unemployment that does things, and it just happens that long-term unemployment happens to be correlated with it. In the Spanish example, it's about the fact that there's no mobility in the Spanish labor market driven by what happens in the Spanish housing market. The other one, in terms of inflation, obviously that might be right, but actually what you have here is, in a sense, in the UK now, is quite a nice experiment over this period, 2008 to 2014. You had inflation at over 5, and you've had inflation now falling down to 1.5. And basically the underemployment rate hasn't moved as the inflation rate has moved. So I don't know the answer to that, but it doesn't look that this underemployment variable at all has moved with the inflation rate, just with the data that we have. So we had much greater spike in inflation in the US, partly because when we pushed down the exchange rate, people like me talked it down, expecting that all the literature saying about the pass-through being low and slow, well, it was actually high and fast. But anyway, so I don't know, but maybe. Thank you.
Justin?
The only question that was directed to me was Andy Levin's asking how we should think about people at the margin of the labour market. And the single best answer I know is a little parable called Betsy Stevenson's Coffee Shop. So rather than tell you that, I'm going to let Betsy answer.
Okay, I will. So Andy, when I was hearing you discuss the issue of how long does it take people to come back and look, and that you actually said, I think, that these people said that they were ready to resume their search if they got more information about openings. It made me, it just, drew to me one of the reasons why, I think about and think we need to have a better understanding of the relationship between participation and fluidity in the labor market. If people don't change jobs and there's not very many openings, then you don't hear about openings. And so the example Justin was talking about was, I was asked at a press briefing in the White House, someone said, you've been talking about this decline in labor market churn and how it affects people. What does this mean for real people? Give me a real life example. And so the real life example I gave is, well, let's say you're a woman who was working and then you had kids and then you had a first kid and a second kid. And by the third kid, you just thought, I can't handle this right now. And you dropped out of the labor market. And now your third kid is 3 or 4 and you haven't worked in a while. And there's the back of your head that's thinking about going back to work, but you're so busy with your 3 kids that you're not actively doing it. But you go into a coffee shop, and we're in a world in which there are tons of job openings because people are moving jobs all the time. And you go into the coffee shop and you run into a friend who says, hey, did you hear about the opening at so-and-so? Because I think they're looking for somebody just like you. Have you thought about going back to work? And maybe you don't get that job, but that prompts you to look into it and to apply. And then there you go, you're back in the labor market. And that's what I meant when I said, I think that there's a lot of serendipitous interactions that pull people back into the labor market. And so it's not just the information. It's not picking up the newspaper and hearing that unemployment's down to 6.1%. It's going out and talking to friends and finding out that there's a lot of openings. Well, when we're talking about net job growth and declining unemployment rates, we're missing the gross. And the gross is what really matters for that serendipitous. It's how many openings are being created in total, not how many openings are there over destruction. And so I think that's one of the reasons we need to be paying attention to labor market flows and understanding better the quit rate. And one of the reasons why, I look at the quit rate a lot, and it has not recovered. I think it's only a little more than halfway to recovered. So I think that is an important link. Let me answer sort of one last question that I think is sort of in there, which is when we're describing the participation rate. I said that I thought There's 0.4 that we really could explain through a standard business cycle effect. But there was a whole percentage point that may be due to long-term unemployment, that may be due to decreases in fluidity, that may be due to the unusual severity of the recession. I think, if you think that 1.4 percentage point participation is all potential slack, and then you think that, 5.4 is a natural rate and we're at 6.1. Well, now, Justin, we're getting into your 2.2 to 4 percentage points. And then one of the things that if I glossed over, let me say it again, the one thing that hasn't recovered in the way that everything else has been recovering is the part-time for economic reasons rate. And I think, we should think of that as potentially being slack. I mean, these people are saying actively that they're looking for more hours, and it's one of the reasons why I think it would be useful to know who else is looking for more hours, but that's also another source of slack.
Can I add something about part-time?
Sure.
I want the answers to the questions to be answered.
Okay. So go ahead, Julie, and then I'm going to jump in.
Well, just on this point of part-time, I agree. I think this has sort of like been the focus and preoccupation at the Atlanta Fed as well as many other places. I think that it's important to keep, in perspective the number of people that are affected by or who are indicating they're part-time for economic reasons relative to other events that have affected everybody across the Great Recession. So there's a new working paper from the Atlanta Fed that measures the decline in family welfare from before to after the recession, looking at how much of that was the result of changes in wages and loss in wages, loss of real wage growth, if you will, and non-labor income, relative to how much of that loss is from not working in as many hours as you want or would be predicted to be optimal. And nearly 80% of that welfare loss across the recession comes from loss in wages and non-labor income. And so I think while this is an extremely important question related to slack and getting the most out of the resources that you have available for fueling economic growth, we need to keep in perspective, I think, the welfare of individuals and how important real wage growth and other losses to family wealth have been.
Okay. Well, let me add. I think it's on. Yeah. The BLS now publishes gross flow data, and this is what I was going to encourage people to take a look at. I think that there are opportunities there for understanding some of the flows that Andy was asking about. We do see a lot of flows from out of the labor force directly into unemployment. Those happen, and I think that there are opportunities there for understanding exactly the kind of behavior you're asking about much more. The other direction I think that could be very useful would be to understand what the other side of the labor market is doing. What is it that the employers are doing and are doing differently? We know there was the advent of the whole lean staffing movement in the 80s, the 90s. Has that changed how employers look for employees, how they adjust to shocks? And also the other big change that I think it's worth it for us to think about is that during that time, we saw an increase in wage volatility for people, and so we thought that meant wages were more flexible. But now we're measuring them as less flexible, so that's a puzzle right there, and worthy of some examination. So with that, I'm going to thank Peterson. Oh, I'm sorry, Michael. Yes.
I don't think I have anything to add. Thank you.
Okay. Well, I'm going to thank Peterson Institute for bringing us together and all of the panelists for teaching us so much this morning.